Good afternoon, ladies and gentlemen, and Assalamu alaikum. Welcome to our second last webinar on IFRS and ISs and the last session on financial instruments. This is the third session on financial instruments. We've already run 2 sessions, and I'm sure you would have seen the recordings of those sessions as well, which have been placed on Vimeo. Secondly, your certificates have also been distributed to all of you who've attended the previous sessions, so I'm sure you'll be happy with that. Welcome to this third session on financial instruments. We've got a jam-packed day today as well, and I'm sure you'll be very happy with such a pack of knowledge being shared with you. Once again, we have with us Mr. Abu Bakr, our expert on financial reporting standards, and I'm sure we received some excellent feedback about him and his effort. All the illustrations that he's prepared, all the solutions that he's prepared, I think they're very, very valuable. And we've been approached by a lot of members who are now asking for all the handouts to be shared with them. Those who were not able to attend the webinars, but they got to hear about the webinars, and they're now asking for the handouts as well as the recordings. So, excellent outcome of all the activities of the effort. Let me very quickly share with you that right after this session, we are planning a session on business intelligence using Microsoft Excel, on sessions on taxation, and on Companies Act, particularly Pakistan. And therefore, between now and 31st of March, which is the year end for ACCA, we've got a lot of activity packed up. Most importantly, all of you are going to receive an invite for the conferences that ACCA is about to hold in Pakistan. These are conferences on very topical issues, mainly concerning Pakistan. The chief executive of ACCA is going to visit Pakistan and is going to become a part of these conferences. I'm going to share the brochures and the invites of these conferences with you. You will be able to, attend these conferences through webinars sitting in the comfort of your home. There are 3 sessions that we've planned. There is one being done from Karachi, one from Islamabad, and one from Lahore. So you will be able to participate in all 3 conferences to your liking. Today's session, once again, like I said, is jam-packed. We will not have too much of time to answer questions because we have to follow a particular plan today. So it will be very, very convenient if you can keep noting down your questions on a notepad, and whenever we give you question answer break, that is the time when you put up a question. That saves a lot of time for us. And most of the questions which are in any case to be answered, if you let the lecture flow, those questions can be avoided. So we will have, as usual, frequent question answer breaks, and I would insist that you hold your questions for the question answer break. If your question has already been answered, please strike it out, don't put it up. But if it has not been answered, and if it's an important question, please, we'll appreciate if you can put up your question during the question answer break, and we'll make sure that your questions are then answered. With that, I'll hand over to Mr. Abu Bakr. Sorry, once again, the announcement about handouts. Your handouts for today's session have been uploaded on GoToWebinar. If you look at your GoToWebinar dialog box, the section under handouts, there are 5 handouts that have been uploaded, and you can download them from there. Some members insist on getting these handouts through an email, so I've got them right here, and I'm about to email them to all the participants as well. So have a very interactive last session on financial instruments, and with that I hand over to Mr. Abu Bakr.
Thank you very much, Mr. Harun. Assalamu alaikum and good afternoon, respected members. So we will continue with our discussion on IFRS 9. Today we shall discuss impairment of financial assets, hedge accounting, and International Financial Reporting Standard 13, and two other things. One of our members requested to explain the concept of mark to market at the end of, towards the end of this session. I will be explaining that concept as well. Then I have brought for you a published financial statement, rather I would say a model financial statement, through which I shall be able to present you how the effects of IFRS, how the effect on different transactions will appear on the face of the financial statement and in the notes to the financial statement. So let's start with the impairment of financial assets. See, so far as the impairment of financial assets is concerned, there are significant changes in the approach of IFRS 9. The old model assumed that all loans would be repaid, and there was until there is an evidence to the contrary. Means that is until the occurrence of an event that trigger an impairment indicator. Very simple. As you people might have learned under International Accounting Standard 36, that you will only review your asset for impairment if there is any indication for that impairment, except in case of like goodwill or the intangible asset with indefinite life. The old approach related to the financial asset was the same, that you need a trigger before assessing your financial asset for impairment. But if there are indications and on assessing you found that the asset is impaired, so you were recognizing that impairment loss. Now the approach has been changed. The new approach is basically, excuse me. Okay, the new approach is basically that you would not assume that the loan would be repaid in full right at the inception, and you will try to estimate. The likely losses on your financial assets without any trigger. See, previously, only when the trigger is there, impaired loan written down to a lower value. But the global financial crisis led to criticism of this approach for many reasons, including that it leads to an overstatement of interest revenue in the periods prior to the occurrence of a loss event and produces deficient information. First of all, we will discuss the old approach with the help of this small illustration. An entity, ABC Limited. As Mr. Haroon announced earlier, your handouts are on the Go to Webinar window. So you can download from there and you can easily find this illustration from there, because when we will move to the answer, this will disappear from your screen. So if you will be having those slides in front of you, so it will be easy for you to see any of the figures that will be referred in the solution. Illustration is, an entity ABC Limited purchased a 5-year bond on 1st January 2010 at a cost of 5 million with annual interest payment of 5%, which is also the effective rate, payable on 31st December annually. If in early 2011, it was identified that the bond issuer was beginning to experience financial difficulty and there was doubt regarding full recovery of the amounts due to ABC Limited. An impairment review would be required. The expected future cash flows now expected by ABC Limited from the bond issuer are as follows. Year ended 31st December 2011, 0.2 million. Year ended 31st December 2012, 0.2 million. Year ended 31st December 2013, 0.2 million. Year ended 31st December 2014, 0.2 million plus capital redemption of 4.4. Calculate the extent of impairment of the financial assets to be included in the financial statements of the company for the year ending 31st December 2011. See how we will calculate. The old approach is very simple. Simply, the original effective interest rate was 5%. These are the remaining cash flows. And the original effective interest rate was 5%. So we will discount these cash flows by applying 5% as a discount factor. So for first year, the factor will be 1 divided by 1 point. I should use this way. For this year, 1 divided by 1.05. And for this year, we will multiply this year 1 divided by 1.05 raised to power 2. And for this, the discount factor will be 1 divided by 1.05 raised to power 3. And the discount factor for the sum of these two figures will be 1 divided by 1.05 raised to power 4. So when we will multiply, this will give us for first year 0.1905, for second year 0.1814, for third year this will give us 0.1727, and for fourth year this will give us 3.7844. So when we total all the amount, this will give us 4.3290. So this is the value of this asset. This is the value of this financial asset after impairment. Financial assets bound. So what will be the impairment? Impairment will be 5 minus 4.329, so 0.671. 0.671 is the impairment loss. So if we move to the solution of this illustration, we can see that here for first year your 5% discount factor will give you 0.1905. Second year will give you 0.1814, and then the third year and the fourth year, this will give you 4.329. So the impairment loss is, this is in fact the recoverable amount of your financial asset. Recoverable amount of your financial asset. Whereas the carrying amount of this asset is, because if we go back to the question, so you purchased this bond on 1st January 2010. So the first year is 2010. Opening balance, as we learned in our previous lecture, opening balance is 5 million. Not working. Voice is okay, fine. No. Opening balance and finance income using the effective interest rate, which is in this case 5%, and this will give us, if we calculate just 5% of 5, so this will give us 0.25, and this is a profit and loss account charge, and this is the cash paid at the nominal rate of interest of 5%, 0.25, which is also the effective interest rate. So this will give us a closing liability. This will give us a closing liability of 5. See, at this point in time, question says in early 2011. Okay, in 2011, this was our opening balance, but there is an adjustment. We assume that this happened on 1st January 2011. We are assuming that, though it is mentioned in the question that in early 2011 it was happened, it was identified. So in early, we can safely assume that this happened on 1st January. This happened on 1st January 2011. We can safely assume that. So what will we do? Simply, on this date, see what are the remaining cash flows. These are the remaining cash flows which are given in the question. These are the remaining cash flows. Discount them using the original effective interest rate. Using the original effective interest rate. And the original effective interest rate was 5%. This will give you the recoverable amount. So this is the recoverable amount and this is the carrying value. The difference between these two will be impairment loss, which comes to 0.671. So we will pass a journal entry, that is debit profit and loss, debit profit and loss with this impairment charge 0.671 and credit this financial asset 0.671. So this entry, we shall pass this entry on 1st January 2011. So this will make the opening balance will reduce by 0.671, and this being opening balance of this financial asset after this impairment charge will become 4.290. And then you continue the same way. Like effective interest rate, and then cash paid, and then closing liability. So then you continue the way we discussed in our previous lecture. Because I have discussed the old approach, if any of our members have any question, please feel free to ask related to the calculation, related to the impairment as per old approach, as per the existing approach, before I move to the new approach. Mr. Harun, can you see please if there is any question? So we can answer it.
But they will fix the number and okay. Yeah.
Can go in for shit. Okay. Now. Okay. Camera, can you camera? Yeah. Audio good. One question. Okay. Qasim Iqbal says, can you please give a quick review of calculation?
Qasim, see, if question is in front of you, so let me change this. I'll give you a quick review of this, because this is important to understand this before moving further.
There's another question from us.
Okay, Mr. Qasim, see, this is the question. Very simple. First year, when you purchased this bond, 1st January 2010, so at the end of 2010, because effective interest rate and cash being paid both are at the same rate, so the closing balance of this financial asset is 5 million. At the start of the next year, at the start of 2011, on 1st January 2011, they identified that there is impairment, and as a result, they estimated that how much will they get from this financial asset. So they estimated that in 2011 they will receive interest 0.2 million instead of 0.25, which is based on 5%, but they will be receiving, because of this impairment, 0.2, and likewise in year 2, year 3, and in fourth year. So instead of receiving 5 million, they will be able to they will receive 4.4 million. What we did, simply one thing is very important, that what we did, we discounted these cash flows. We discounted all these cash flows using the original effective interest rate. This is important. Original effective interest rate. And original effective interest rate was 5%. 5%, when we multiplied these discount factor with these expected cash flows, this will give us the recoverable amount. Whereas the carrying amount of this financial asset, I might have written it as a financial liability, but in fact it is a financial asset. So financial asset, carrying amount of this financial asset at the start of 2011, as we discussed earlier, was 5 million. So the recoverable amount is this much. The difference between these two figure, which comes to 0.671. This is impairment loss, in fact. So for impairment loss, you know the entry, very simple: profit and loss account debit, and that respective asset credit. So here, when you will credit this respective asset, so this will make this asset 4.3290. Okay, next question. Qasim, I hope it should be clear.
Sayyid Salam Gilani was saying, shouldn't this 4.329 be deducted from the present value instrument?
Again, please.
Shouldn't this 4.3290 deducted from the present value instrument?
Present value of the
Instrument.
Yes, we deducted. That's why we calculated this impairment loss. That's why we calculated. This is the difference between these two figures.
So I'm saying points there. Thank you. Burhanuddin RFI is saying this 0.61671 loss will be booked in the first year.
No, because this was identified at the start of 2011, so this will be booked at the start of 2011 in the second year.
That's it.
Okay. So let's talk about the new approach. This was the old approach we discussed in the previous slide. This is the new approach. Expected credit losses model. See, the difference is incurred. Here, expected. You will be recognizing the impairment of that asset based on the expectation when you initially recognize an asset, or you will keep on estimating the expected loss on your financial asset. You will not wait for any trigger. You will not wait for any trigger. You will impair your asset. You will decrease the value of your asset based on the expectation. See, the new approach eliminates the need for a trigger event to recognize impairment losses. An entity will make an ongoing assessment of expected credit losses, which will be updated, and movements will be recognized at each reporting date. This will result in impairment losses being recognized earlier than under the ISA 39 incurred loss model. So this is the new model. Okay, I will try to explain it with a number of short illustrations. Under IFRS 9, the same impairment model applies to the following: financial assets measured at amortized cost, financial assets mandatorily measured at fair value through a comprehensive income, loan commitments, financial guarantee contracts, lease receivable within the scope of ISA 17. Lease receivables mean we are talking with reference to the lessor, and we know that whether it is ISA 17 or IFRS 16, the accounting treatment is the same. So this means this will also apply to IFRS 16. Contract assets within the scope of IFRS 15. From contract with customers, the right to consideration following transfer of goods or services. So IFRS 9, the new model will apply to all these assets. Okay. Expected credit losses model. What is this? Expected credit losses are defined as the expected shortfall in contractual cash flows. Expected shortfall in the contractual cash flows. The estimation of expected credit losses should consider past events, current conditions, and reasonable and supportable forecasts. Then, There are basically three stages. Your asset can fall in any of the three stages. At initial recognition, an entity shall estimate the cash flows expected by considering all contractual terms of the financial instrument and estimating reliably the expected life of financial instrument compared with the cash flows it expects to receive. If the credit risk of the financial asset is assessed to have increased significantly since initial recognition, it enters into the stage 2. If the credit risk of a financial asset increases further to a point where it is considered to be credit impaired, it falls into stage 3 of the model. So these are the three stages. I will repeat. At initial recognition, an entity shall estimate the cash flows expected by considering all contractual terms of the financial instrument and estimating reliably the expected life of the financial instrument compared with the cash flows it expects to receive. If the credit risk of the financial instrument is assessed to have increased significantly since initial recognition, means subsequently, then it enters into stage 2. Further, if it is objectively evident that the asset is credit impaired, then it falls into stage 3. Okay, let's discuss these stages in turn. How will it affect our accounting treatment? If an asset falls under stage 1, or if an asset falls under stage 2, or if an asset falls under stage 3. First of all, stage 1. See, at initial recognition, an entity shall estimate the cash flow expected by considering all contractual terms of the financial instrument and estimating reliably the expected life of the financial instrument compared with the cash flows it expects to receive. If at initial recognition, the cash flows it expects to receive are less than those in the contractual terms. I repeat, if at initial recognition, the cash flows it expects to receive are less than those in contractual terms, 12 months expected credit losses are recognized immediately in the profit and loss account and deducted from the carrying amount of the financial instrument by way of a loss account in the statement of financial position. On initial recognition, if you see that there is though there is no significant deterioration, on initial recognition, if you expect that you will receive cash less than those in the contractual terms, if you just expect, then you will be recognizing 12 months expected losses. You will calculate, you will estimate, the expected losses over the period of next 12 months. So on initial recognition, you will be recognizing that. Even subsequently, at each reporting period, if there is no significant deterioration in the credit risk, even then you will be recognizing 12 months expected credit losses. At each reporting date, the financial asset credit risk will be assessed. If there is no significant increase in credit risk since initial recognition or the financial asset is deemed to be low credit risk, it remains in stage 1 of the model. 12 months expected credit losses shall be recognized at the reporting date. So this is the stage 1 where you will be applying this 12 months expected credit losses. Then is the stage 2. See, stage 2 is when your credit risk increased significantly since initial recognition, this asset enters stage 2 of the model. This stage recognizes full lifetime expected credit losses. This means that is an expected present value measure of credit losses that arises if a borrower defaults on their obligation throughout the life of a financial instrument. They are the weighted average credit losses with the respective probabilities of default as the weights. There is a rebuttable presumption that the credit risk on a financial asset has increased significantly since initial recognition when contractual payments are more than 30 days past due. However, an entity cannot solely rely on the past due information and should also assess reasonable forward-looking information, as in stage 1, the movement in expected credit losses is recognized in the profit and loss and through the loss allowance account in the statement of financial position. However, if at the reporting date the credit risk has not significantly increased and the instrument will remain in stage 1 of the model. See, the concept is very simple. You have a financial asset. You have a financial asset. Financial asset. On initial recognition, if you expect that you will receive less cash than expected from the contractual terms, you just only expect. So this means your financial asset is in stage 1. Subsequently, at each reporting period, if there is no significant deterioration in the credit risk of this financial asset, this means still that this asset falls under stage 1. If an asset falls under stage 1, the standard says at minimum you will have to recognize the 12 months expected credit losses. We shall learn very shortly that how can we calculate 12 months expected credit losses. But what if subsequently the credit risk increases significantly? Then this asset will falls under stage 2. So then you will be recognizing lifetime expected credit losses. Okay. Then the third is stage 3. See, if the credit risk of a financial asset increases further to a point where it is considered to be credit impaired, it falls into stage 3 of the model. As objective evidence of impairment exists at the reporting date for these financial assets, full lifetime expected credit losses are recognized. It seems perhaps this is the same as in case of stage 2. From this slide, at least it seems the same, but when we will discuss the accounting for those assets which fall under stage 2 and those assets which fall under stage 3, there is a difference. So that's why these stages are different. What is the difference between these two stages? In stage 2, there is no objective evidence, but you estimate that there is a significant deterioration. But when a financial asset will fall under stage 3, when there is an objective evidence, verifiable evidence, that the asset is significantly impaired, then you will be recognizing the lifetime expected credit losses. So this was a sort of theoretical portion. So let's learn how to calculate expected credit losses, whether 12 months expected credit losses or the lifetime expected credit losses. Though this will vary from entity to entity, but I have selected a couple of illustrations just to make it understandable. How can we calculate the expected credit losses? Lifetime. First of all, we shall learn how to calculate lifetime expected credit losses. An expected present value measure of credit losses that arise if a borrower defaults on their obligation throughout the life of a financial instrument. I will repeat. An expected present value measure of credit losses that arise if a borrower defaults on their obligation throughout the life of a financial instrument. So let's understand with the help of this illustration. Of course, after discussion of so after discussion of the calculation, how to calculate lifetime expected credit losses or 12 months expected credit losses, I will be in a position to answer your question. So please hold your question by the time I finish my discussion on these calculations. So thereafter you should start asking your question, and I will try to have a short break so that I could answer most of your questions. Okay, this illustration is in front of you. The bail company has a portfolio of $50,000 financial assets that have 2 years to maturity. Have 2 years to maturity. This is the life of this asset. 50,000. This is the value given in the question, and are correctly accounted for at amortized cost. Fine. Each asset has a coupon rate of 10% as well as an effective rate of 10%. Fine. No previous impairment loss has been recognized. At the year end, information has emerged that the sector in which the borrowers operate is experiencing tough economic conditions. It is now felt that a proportion of loan will default over the remaining loan period. What is the remaining loan period? This is 2 years. This is the remaining loan period. Okay. After considering a range of possible outcomes, the overall rate of return from the portfolio is expected to be approximately 6% per annum for each of the next 2 years. Okay. What is the requirement? Requirement is calculate the expected credit losses on a lifetime basis. See, without these losses, what will be our annual interest? Our annual interest will be, see, 50,000 multiplied by 10%. So this will give us 5,000 per annum. Okay. So what is expected? Overall rate of return from the portfolio is 6%. This means this was original, but as a result of expectation, we shall be able to receive only 3,000. So this means loss in the return is 2000. This was originally agreed and this was originally expected, which is calculated by applying 10% on this 50,000. This was our return. As a result of this new information, we expect that we shall only receive 3,000. This means our expected loss per year is equal to 2,000. So please note that, because when I move back to my previous slide, so this working will be lost. Okay. See, in our last slide, what we learned that the present value of the credit present value measure of the credit losses that arise if a borrower default on them. This means what was the credit loss? 2,000 per annum is the credit loss and expected present value. So we shall calculate so this is the solution. We shall calculate for year 1. For year 1, this is the present value, and for year 2, this is the present value when we applied the 10% discount rate. So this will give us expected credit losses. This will give us expected credit losses. So this is basically the credit loss on this asset. This is the expected credit loss, lifetime expected credit loss. We shall reduce our asset with this amount. We shall reduce our asset with this amount. So this is the approach for the calculation of lifetime expected credit losses. Mean by taking into account all the factors, not only the present situation, but also the factors related to the future. You estimated that this will be the shortfall. This will be the shortfall, and you calculated the present value of these shortfalls. This will give you the lifetime, because these shortfalls are over the life of the financial asset. So when you calculated the present value of these shortfall, this will give you the lifetime expected credit losses. So what will you do? You will decrease your financial asset with this amount, and the second effect will go to the profit and loss account. Second effect will go to the profit and loss account. Okay, now another example for 12 months expected credit losses. 12 months expected credit losses. An entity calculates 12 months expected credit losses by multiplying the probability of a default occurring in the next 12 months by the total lifetime expected credit losses that would result from that default. Okay, let's understand it with the help of another illustration. Entity A originates a 10-year amortizing loan for 1 million. Entity A estimates that the loan at initial recognition has a probability of default of 0.5. Probability of default of 0.5% over the next 12 months. That is 99.5% probability that there is no default. At the reporting date, entity A determines that there was no significant increase in credit risk since initial recognition. Entity A determines that 25% of the gross carrying amount will be lost if the 25% of the gross carrying amount will be lost if the loan defaults. Required. Calculate the expected credit losses on a 12-month basis. Here we have a solution. At the reporting date, the loss allowance for the 12 months expected credit losses is 1250. This is calculated by multiplying this 25% with the 1 million and then 0.5. 0.5% is the chance of default during the next 12 months. If you go back to this slide, see, by multiplying the probability. So what was the probability? Probability of default was 0.5%. This was the probability of default occurring in the next 12 by the total lifetime expected credit losses. What was the expected credit loss? That was 25% of 1 million. This was the lifetime expected credit losses, and the probability that this loss will occur during first year is 0.5%. So this will give you the 12 months expected credit losses. So now I can take the question. We have the question. If you have a question, please ask now. We have a couple of questions. Arun Bhatti asked, could you please illustrate how IFRS 9 applicable to contracts under revenue IFRS 15? Arun, see, when there is a significant financing arrangement in your revenue transaction, so you will be applying the guideline given in IFRS 9 to that receivable. So this means your revenue will be the present value of the future receipt. So subsequently, your account receivable will be treated in accordance with IFRS 9. I repeat, Arun, again, that if there is a significant financing portion in the revenue transaction, then you will be applying IFRS 9 for the calculation of the revenue. Arun Bhatti, I hope it should be clear. Next question is, whether expectation of credit losses based on past or some specific criteria should be fulfilled in stage 1. Credit losses based on past or some specific criteria should be. Yes, but you need to take into account the future as well. Then Mr. Jamshed asked, sir, have check email. Mr. Jamshed, should I check my email? But because I am live, it is not possible for me to check my email. Okay, Imran Samad, I suppose it is Samad, sorry. Imran Samad said, is in this illustration how you have determined the stage, which stage this financial asset is in. Okay. Which illustration? We have two illustrations here. One illustration is, this is first illustration. Imran, I suppose you are talking about this. See, it is no felt. It is given in the question. that a proportion of the loan will default over the remaining loan period. Okay, after considering a range of possible outcomes, the overall rate of return from the portfolio. So they are expecting that this loss, though we have not learned here how to calculate the stage, but this is the calculation of lifetime expected losses. Lifetime expected losses we calculate under two stages, stage 2 and stage 3. This illustration, Mr. Imran only tells us how to calculate lifetime expected credit losses. It does not relate to the determination of the stage. Next is Zishan Hafiz. What's these? Zishan, can you clear your question? I'm not clear about your question. 25%. Fateh Muhammad, sorry, why did we multiply to 25%? See, you are talking about this next illustration, this one. Sorry, this one. See, it is written here that entity determines, entity estimated that 25% of the gross carrying amount will be lost. 25% of the gross carrying amount will be lost if the loan defaults. So that this is the 25% which we used over there. Fatih, I hope it should be clear. Okay, next is Sayyid Qadirul Hassan. What's the difference between stage 2 and 3, since both are under lifetime impairment? Sayyid Qadir, you are very right. Under both stages, we go for the lifetime expected credit losses, but there will be a difference in the recognition of interest revenue, which will be discussed very shortly. So that's why we separated these two stages. So far as the discussion so far is concerned, there is no difference. Okay, how can an accountant determine the probability of default? Calculation at year end. Any best estimate example? Asked by Shahid Hassan. Shahid Hassan, of course, you will have to apply the judgment. Now the accountant will have to train themselves, will have to learn the techniques for this purpose, of course. A lot of estimation is involved in this. You're very right. Zishan said it's all clear. Thank you, Zishan. Fateh Muhammad said thank you. You're welcome, Fateh. Then, okay. Now let's move further. Okay, calculation of effective interest rate. If your asset falls under stage 1, you will be calculating on gross carrying amount. Like in our last example, what was the gross carrying value of our asset? It was 1 million. 1 million. So if the interest rate is 5%, I am assuming 5%. So on this asset, you will be calculating, you will be applying this 5% to this gross amount instead of 1 million into 0.75%. I repeat again. See, in our last example, the asset gross carrying amount was 1 million, and impairment, after impairment, this was the net. We can calculate the net carrying amount. So if an asset falls under stage A, stage 1, we shall calculate interest on this gross carrying amount. Next is stage 2 on gross carrying amount. For stage 1 and 2, calculation of effective interest rate is the same. Only in case of stage 3, on a net basis, on this basis, on the net basis, we will be calculating on the net basis. So one of our respected member was asking what is the difference between stage 2 and 3. So this is the difference between stage 2 and 3. In stage 2, interest income will be calculated on the basis of the gross carrying amount without taking into account the expected credit loss effect. But in case of stage 3, after you will be calculating the finance income after deducting the expected credit losses from the carrying value. So this is the difference. Okay, next is then there is a simplified approach for trade and lease receivables. What is that simplified approach? For trade receivables that do not have an IFRS financing element, the loss allowance is measured at the lifetime expected credit losses from initial recognition. Straight away, right from initial recognition, such trade receivables you can apply the lifetime expected credit losses. For other trade receivables, of course, that may have an IFRS financing element, and lease receivable, the entity can choose as a separate accounting policy for trade receivables and for lease receivable to apply the 3-stage approach or to recognize an allowance for lifetime expected credit losses from initial recognition. In simple word, that in case of receivables, trade receivables and lease receivable of course related to the lessor. So for those trade receivables where there is no financing element, you right from the initial recognition you can calculate the expected credit losses over the life of that trade receivable, and you can recognize that right at the initial recognition. You can create an allowance for that purpose, like you create allowance for doubtful debt, things like this. But for those trade receivables and lease receivables, for trade receivable where these have significant financing element, and for lease receivable, these two types of receivable, the standard gives you an option either to go for the guideline given in the stages, or you can go for a single approach, which is lifetime expected credit losses from initial recognition. And we just learned what are the 3 stages. Like on initial recognition, if you expect you will be recognizing 12 months expected credit losses. Subsequently, at each reporting date, so this will be the stage 1. Subsequently means at each reporting date, if there is no significant deterioration in the credit risk, then that asset will remain in stage 1. This means again that 12 months expected credit losses will be recognized. But if there is a significant deterioration in the credit risk, then that asset will be moved from stage 1 to stage 2, where lifetime expected credit losses will be recognized. Further, if subsequently there is an objective evidence that these objective evidence that there is a significant deterioration in the credit risk, means then this will enter into the stage 3. So you have the option for trade receivable with a significant financing component and lease receivable. You have the option whether you go for the approach under which you can see the stages, or you can go for the lifetime expected credit losses at initial recognition. So standard has given you the option. An impairment shall be recognized in the profit or loss, and a loss allowance account recognized against the carrying amount of the financial asset unless it is measured at fair value, through other comprehensive income, in which case the impairment losses are recognized in the profit or loss, and the loss allowance account is shown in other comprehensive income, along with any fair value movements in the financial statement. However, for loan commitments and financial guarantee contracts, the loss allowance is recognized as a provision. So this is a small difference. The standard requires an entity to disclose information about the changes in a loss allowance for financial assets separately from those for loan commitments and financial guarantee contracts. Then, if you purchased or you originated a credit impaired financial asset, treatment is very simple. Credit losses recognized, lifetime expected credit losses at initial recognition. These assets are accounted for differently, and the credit deterioration impairment model outlined above is not applied. Means stage 1, stage 2, stage 3 will not be applicable. They are considered to be the credit impaired at initial recognition due to the circumstances at purchase or origination. Therefore, an entity shall recognize the cumulative changes in lifetime expected credit losses since initial recognition through a loss allowance account. The interest revenue shall be calculated using a credit adjusted effective interest rate on the amortized cost carrying amount. Okay. Possible effect of the new model: earlier recognition of credit losses. Because previously you were waiting for a trigger, something to happen on incurred basis, but now you will be recognizing your losses on expectation basis. So you will be recognizing your credit losses on expectation basis. This means earlier recognition of credit losses. More judgment will be involved. One of our respected members commented on this. Of course, more judgment will be involved, and one need to be trained in these techniques for this purpose. If an entity is using a lot of financial instruments and financial assets, financial liabilities, so their accountant will have to be trained in these techniques. Implementing new model will be costly, of course. If you involve some consultants, of course, that will cost you much. Okay, we have questions with us. Okay, let me look at the questions. Okay, Mr. Awais Mumtaz. Respected member, that's all about from my side on the impairment of the financial asset. If you have any question, please feel free to ask now before we move to the next topic of hedging. Mr. Awais Mumtaz asked, I believe that the credit and risk department has a job as well in identifying and calculating the expected losses. Of course, Sayyid Kadir, of course, if your organization has such a department, of course they should estimates. They should make estimate in this regard for the purpose of accounting. So this was the impairment. Now we can move to the next topic. So this, thank you, just represents that we have finished with our first area. Now we move to the hedging. Hedging. We shall learn under hedging fair value hedge. What is the definition of fair value hedge? Accounting treatment of fair value hedge with the help of at least one illustration. Then we will discuss cash flow hedge. What is the definition of cash flow hedge? And then what is the accounting treatment of cash flow hedge with the help of illustration. Hedge of a net investment in a foreign operation. We shall discuss this as well. Before I start discussion, Mr. Awais from TAS asked a question, sir, why to take so much subjectivity by expected loss approach, as I will help entities out of revenue, as it will help entities cut off revenue. Mr. West, what I understood from your question, you mean that this will be a costly exercise. You are very right. This will be a costly exercise. If you have a lot of financial assets of different types, and of course, in order to apply the requirement of IFRS 9 so far as the impairment of those assets are concerned, you will have to develop the mechanism within your organization for these estimations and judgments. So this will be costly, of course. Please first define what is hedging with Rashid Hanif. Okay, Rashid, hedging is basically when you want to protect yourself. I'm not defining it formally. I'm just discussing the meaning of hedging. When you have, for example, when you have a transaction, like you sold assets, you sold inventory to a foreign customer, and in 2 months' time you will be receiving an amount in foreign currency. So you are afraid, as a result of change in the exchange rate, you may get a lower amount in local currency as it should be given the exchange rate at the date of transaction. So this is the risk, that you will be receiving a lower amount. So you try to protect yourself from this loss. So this is termed as hedging. When you try to protect yourself, for example, as this is a rainy season here in Pakistan, so simply hedging is like this. You protect yourself. Losses. Like if you have a firm commitment that you will be buying an asset in the future. So you are afraid that you have a commitment for $10,000, you will be buying that asset for $10,000. But in fact, at that point in time, this asset may be in the open market cost you $95. So because you have a firm commitment for buying at this rate, so you are afraid that if the change in the fair value of this asset, you may end up in loss. So in order to protect yourself, you go for the hedging. You go for the hedging, and so hedging is basically protecting yourself from the future expected losses. Like if I go for a couple of more examples, if you have a loan at a fixed rate of interest, like 2%, but you are afraid that in the future interest rate may go down and you are still paying at the rate of 2%, and you enter into a swap, whereby you exchange this fixed rate with the floating rate. So this is again the hedging. You protected yourself from a loss. But whether you are able to protect yourself, that depends on the situation and the circumstances in the future. Rashid Hanif, I hope I tried to explain this hedging concept. I hope it should be clear. Zishan Hafiz said NYC. Okay, Rashid. Okay, Rashid said yes. Okay. NYC drawing. Zishan Hafiz, what do you mean by NYC drawing? I cannot understand. Okay. Anyway, I move further, but once Zishan, you can send the explanation of your abbreviation. So I will try to answer that as well. Okay. The next is, first of all, types of hedge depends on the risk being hedged. See, you want. Okay, thank you. Otherwise, thank you very much. Thank you very much. So what kind of hedge? Because we discussed at least 2 types of hedge. I mentioned 3, but the third one is basically hedge of a net investment in a foreign operation. Those foreign operations will be hedged either using fair value hedge or the cash flow hedge. So we will see. But in fact, either you will be entering into a cash flow hedge, or a fair value hedge, So it depends on the risk being hedged. This is very important concept. I will try to explain it in a very simple term. If you are able to appreciate what I discuss, so this will be very helpful in your practical situations. Okay. Okay, first of all, fair value hedge. Fair value hedge is a hedge of the exposure to changes in fair value of a recognized asset or a liability or an unrecognized firm commitment or a component of any such item that is attributable to a fixed risk. This is very important. See, I hope I need your special attention here. Like attributable to a risk that could affect profit and loss account, component of any such item, particular risk. Under fair value hedge, you have some fixed item. You are worried about that will fluctuate with the market. Okay? You are worried about that fixed item. So you hedge that fixed item basically. Like for example, when you want to hedge a fixed item, this is termed as fair value hedge. This is the key word. Because this is the weak point. So it is better I will try, and you should try with me as well to make it, to understand it. Okay. So let's understand with the help of a couple of examples. Like inventory. So an exposure to fall in the fair value of an inventory. An inventory is already on your financial statement. It is there, it is with you. And you bought it for example, say for $100. And you are worried there may be a fall in the value of that inventory. Next is fixed rate debt. Fixed interest rate loan. So you are worried about an exposure to changes in the fair value due to changes in market. So there may be a changes in the market interest rate, whereas you have agreed a loan on fixed rate, and you are worried about there may be decrease in the interest rate in the market, whereas due to this fixed commitment you you are worried that you will have to pay at the higher amount. Then is an asset with a fair value of 200 million. You are concerned that this asset may fall in value. Similarly, unrecognized firm commitment, the fair value may change. So these are the examples of fair value hedge. See, a fixed asset item means that the item has a fixed value in your accounts. All these have fixed value in your account, fixed value in your account. This is fixed value in your account. Like if you agreed 3%, 3%, and this is the fixed value in your account. And here, because of the firm commitment, you have a fixed value and require a fixed amount of cash in the future. So this will require a fixed amount of cash in the future. This will require a fixed amount of cash in the future, like this. And the same applies to the unrecognized firm commitment that have not been sitting in your accounts yet, but they will be in the future. And when it comes to hedging fixed asset, fixed item, when it comes to hedging fixed item, that you are particularly dealing with the fair value hedge. This is very important. When you are hedging a fixed item, this means you are going to deal with the fair value hedge. Okay, let's move next. Here is a message. Use new hardware. Okay. Okay. This is okay. So fair value hedge, accounting treatment of fair value hedge. We will use this illustration in order to explain the accounting treatment of fair value hedge. So let me open these slides in front of me as well. On 1st July 2006, ABC Limited acquired 20,000 kgs of a material, which it held in its inventory. We shall be having a break in about 30 minutes. As per Pakistan Standard Time, 5 to 5. Okay, on 1st July 2006, ABC Limited acquired 20,000 kg of material which it held in its inventory. This cost $100 per kg, so a total of 2 million. ABC Limited was concerned that the price of this inventory would fall. So on 1st July 2006, the entity sold, he's wrongly mentioned here, the entity sold 20,000 kg in the futures market for $105 per kg for delivery on 30th June. So this means this is the item and company is worried about because its cost is fixed, which is 2 million. Entities is worried about that the value of the inventory in the market may fall and they may get a lower amount than at least 2 million. So they want to hedge this fixed amount which is lying in their account. This 2 million is lying in their account. This is the fixed item. They want to hedge this. So this will be the hedged item. This will be termed as hedged item. How will it be hedged? This will be hedged by using futures contracts. Futures contracts. So this means future contracts will be hedging instruments. Future contracts will be hedging instruments. Okay. Hedging instruments. So prepare accounting entry in respect of above transactions. So what is the accounting treatment for this? See, hedging instrument in this question, hedging instrument is futures contracts. In this last illustration is future contract is the hedging instrument, and the hedged item is inventory. This is the hedged item. Inventory is the hedged item, and hedging instrument is the future contract. The gain or loss resulting from remeasuring the hedging instrument at fair value is recognized in profit or loss. And similarly, for hedged item, gain or loss on hedged item attributable to the hedged risk should adjust the carrying amount of the inventory. Carrying amount of the hedged item mean carrying amount of the inventory. If there is an increase in the value of inventory, this will be a gain. So you will debit the inventory and credit the profit and loss account. And if there is a decrease in the value of the inventory, you will credit the inventory, means you will credit the hedged item and debit the profit and loss account. If the hedged item is a financial asset, through other comprehensive income, the gain or loss on the hedged item is also recognized through profit and loss. So we will keep ourselves to this point. The last illustration will explain the concept till this point. So future contracts at each reporting date and subsequently at the transaction date, we shall keep on remeasuring it, keeping in view its fair value. So any gain or loss in this market, we shall be either debiting or crediting financial instrument, and the second effect will be debited or credited to the profit and loss account. And so far as the inventory is concerned, if there is an increase in value, inventory will increase, and if there is a decrease in value, inventory will be decreased, and the second effect will go to the profit and loss account. Okay, so let's go back to the normal mode. Okay, we'll try to come back to this slide. Okay, before moving to the cash flow hedge, I can use this slide for the, okay, we can have another document for this purpose. Okay, we can use Word for this purpose. Okay. So here on this side of the page, hedging instrument, which are futures contracts, which are future contracts. And on this side of the page, hedged item, which is inventory, As per the information given in the slide in illustration number 5, on 1st July, so our first reference date will be 1st July 2006. Value of this inventory in our books is 2 million. Okay. Then on the same date, we sold this inventory in the futures market as well. Sold 20,000 kg at the rate of 105. Here the rate is 20,000 into the rate is 100. Because we sold in the future, so I mentioned here figure without bracket. Okay. Now what happened next? Next on it is mentioned here on 1st July 2006. The condition for hedge accounting were all met. Fine. At 31st December 2006, the end of ABC reporting period. Now, reporting period is 31st December 2006. The value is increased to. The value is increased to, of course, quantity will remain the same. The value is increased to 110 in the open market. So this means there is a gain. I will use G for gain. Gain is $10 per kg. So this means 20,000 kg. So this will give us a gain of 200,000 at the reporting date in the hedged item. Why? Because in our books of account, this inventory was valued at 2 million and per kg rate was $100. On reporting date, the price of the inventory in the open market is increased by $10 per kg. So this means there is a gain of $10. So what will be our entry for this gain? As we learned, this is a gain, debit, inventory account or stock account, inventory account with the amount of gain which is 200,000 and credit profit and loss account with 200,000 So at this date, this will be the entry, and on the same date, the value of the future has increased to 113.5. I suppose, yes. No. At 31st December 2006, the end of ABC Limited reporting period, the fair value of the inventory was 110 per kg, while the future price for 30th June delivery was okay 113.5. So the future price has become 113.5. So this will give us a loss, because in order to calculate gain or loss in the future market, what we originally did, we assumed that we will assume that we have done the opposite in the futures market. So we bought 20,000 kgs at the rate of 113.5. So this will give us a loss of 8.5. So when we multiply per kg loss to the total quantity, so this will give us the total loss in the future market. See, financial management concepts are inevitable even for an accountant. I suppose 8.5. So this will give us 170,000. So we shall pass the entry because this is a loss. So profit and loss account debit with 170,000 and credit futures contract. So we can safely say it has become financial liability, as we learned right at the start of the first session. Like if your forward contract is at a loss, so that is your financial liability. You can use the word future contracts account like this, but no, because it is at loss, so this will become your financial liability. Financial liability, which is future contract account, will be credited with the same amount, 170,000. Okay, what happened next? Subsequently, on 30th June, the traders sold the inventory and closed out the future position at then spot price of 115. So now we will see the situation on 30th June 2007. So the value is increased to 115. So as we have already recognized the gain of 10, so we shall be recognizing the remaining gain, which is $5 per kg. So this will give us $5 per kg will give us 100,000. 100,000. Gain will be 100,000. And entry will be on this date debit inventory account, because inventory is increasing. This is our hedged item and we will debit this hedged item, and credit profit and loss account 100,000. Now what happened here on 30th June 2007? On 30th June 2007, see, now the price will become the spot rate. Now the price will become the spot rate, which is now 115. Our last price was this. So there is a further loss. So what is the loss amount per kg? That is 115 minus 113.5, means this will give you minus 113.5. This will give you 1.5. This is the loss in the future market. 1.5. loss in the future market, total loss will be 1.5 into 20,000 kg. This will give you 30,000. Again, we will pass the entry debit, profit and loss account with this loss, and credit future contract account, which we named as financial liability, keeping in view the concept which we learned in our first session, that a future at loss will be our financial liability, 30,000. So these will be the journal entries before going for the entries for the sale of this inventory. So if we look at the account, inventory account will appear like this. Initially, you bought this inventory for 2 million. 2 million. I suppose these are 6 zeros, but anyway, consider it as a 6 zeros. Then on 31st December 2006, we passed this entry. This means against profit and loss account, we passed this entry to 200,000. 200,000. And then again on 30th June, so this will give us the closing balance at the end of 2006. At the end of 2006, which is 2.2 million. Which is 2.2 million. Next year, this will become the opening balance, which is 2.2 million. Again on 30th June 2007, you pass this entry. This will make this account. This will become in total 2.3 million. On this date, you sold this inventory. When you sold this inventory, of course, this amount will go to the cost of sale. This amount will go to the cost of sale. 2.3 million will go to the cost of sale. And likewise, financial liability, which is future contract, we are assuming that financial liability, which is future contract, we are assuming that we have not paid any initial margin. We have not paid any initial margin on this future contract. So on 30th June, you would have passed this entry against profit and loss account, and 170,000 will appear in this account. And at the end of 2006, the closing balance will be 170,000. Opening balance will become in 2007 170,000. And again you pass this entry with 30,000. So this is the total amount lying in your financial liability. You will be settling this amount with cash of 200,000 by paying 200,000 to the broker. Mean the entry for this will be debit, financial liability, debit. Okay, my pen is, I think, not moving the way I want. Okay. financial liability debit, this amount will be paid to settle the loss on your future transaction. The total amount is 200,000. Credit cash 200,000. Okay, after completion of this calculation, we are in a position to take your questions. Imran Samad said, yes, I answered your question. We'll be having a break in about 10 minutes. Hussain Abdullah asked, with regard to hedged inventory, gain, should it not be you are right, that's why Hussain Abdullah, see, because of the limitation of scope, so I just mentioned the whole amount within this bracket. So gain is starting from here, so I mentioned G here, so this is the gain. Of course you are right that this will be the difference between 110 and 100, but if you apply the bracket, so this is the difference between these two brackets, this is the gain 200,000. Hussain Abdullah, I hope it should be clear. I am referring to transaction on 31st. Hussain Abdullah, you are referring transaction on yes, Hussain Abdullah, I hope it should be clear. I answered you with reference to the same. Okay, I am waiting your answer. Who has earned this 2000K? Sayyid Kasrul Qadirul Hassan. I suppose Qadirul Hassan. Qadirul Hassan. Who has, Qadirul Hassan said, who has earned this since it's our loss? Yes, the other party to this future has earned this gain, of course, since it's our loss. Yes, you are right. Sayyid Qadirul Hassan, the other party on the future, who is the purchaser of this future, will earn. But this is a nominal gain or loss till it is settled. At the end, if the price continue moving the same way, whatever is the spot price, the future price will be exactly the same at the maturity date. So if you are in loss, you will have to pay it to the broker. Okay. Fateh Muhammad asked, in futures contract transactions, there is no physical change in the goods. Is it correct? Fateh, you are right, it is correct. In hedging instrument, why difference of 105 and 113 is loss? Rashid Hanif. See, Rashid, your actual transaction was you sold the futures at the rate of 105. You sold means that at the maturity of these futures, you will have to sell 20,000 kgs of inventory. So, to the extent of calculations only, at the rate of 105. So, if in the future market it is moved to, because you will be closing this future with the future. If future price moves to 113.5, so in order to close your original position of selling, you will have to purchase, you will be purchasing the inventory 20,000 kg at the rate of 113.5. If you purchase at a higher rate and sell at a lower rate, so this will give you a loss. But see, Rashid Hanif, these loss is only for the purpose of calculation as the price moves in the future market. Okay, at 2006 closing, ROE 30,000 loss. There is no 2016. I suppose you are Sayyid Arsalan Gilani said ROE 30,000 loss. Sayyid Arsalan Gilani, can you please explain your question? Hamza Shehzad said there is no voice, so please rest of the respective members also comment if they are not able to listen to me. Can you listen me? Please answer with yes or no so that I could get the idea whether I am reaching you or not. Tayyib Asmir said yes, Rashid, Abdullah. A lot of people are saying yes. Okay, fine. So this means, Mr. Hamza, can you check your system, because rest of the respective members are saying yes. Okay, Sayyid Qadir ul Hassan say, can you please also explain IRS concept and accounting? IRS concept and accounting. Sayyid Qadir ul Hassan, please elaborate your question, but if it is related to the material which we are going to discuss, then I will be able to answer this. Otherwise, you already know we have a material plan for this session. Okay, Krishna, he said yes. Okay. Sayyid Qadirul Hassan said interest rates, of course, we shall be discussing. Sayyid Qadirul Hassan, of course, we shall be discussing maybe in the form of example, but one or the other way we shall be discussing the interest rates. Okay. Qadirul Hassan, you're welcome. You said thank you. Welcome. Okay, I'm moving from this working and to the next slide. We can take its. So next slide is. Okay, let me select from here normal mode. Okay, what we learned here, see, we learned here the hedging instrument. The hedging instrument, which was which were futures contract, the gain or loss resulting from remeasuring the hedging instrument at fair value is recognized in profit and loss. And then we learned about hedged item, that was inventory. The gain or loss on the hedged item attributable to the hedge risk should adjust the carrying amount of the hedged item and be recognized in profit and loss. So if the hedged item is a, okay, let's move to the next. If the hedged item is a financial asset through other comprehensive income, mandatorily, the gain or loss on the hedged item is also recognized through profit and loss. Except, however, if the hedged item is an investment in an equity instrument held at fair value through OCI, the gains and losses on both the hedged investment and the hedging instrument will be recognized in OCI. Now we shall be having a 15 minutes break. You can say your prayer if it is a prayer time in your place. So we will be back approximately after 15 minutes. Okay, welcome back. Before moving further, we shall be having two pop-up questions in order to warm up you people, so that we could get the idea that you people are with us. So, Mr. Harun, can you please pop up the first question?
The new impairment model is based on,
Yes.
yeah, the new impairment model is based on incurred credit losses, expected credit losses.
We'll have to have one more break for model, but the duration is very short, like 35 minutes.
6 o'clock.
Quarter to 6.
Are you feeling all right?
No, because of heat, I closed that.
Yes. 6 o'clock.
Plus
We
because
still received responses from about 22% members, and members need to get back and submit their poll answers. So giving a little bit more time. So members were getting back after the break. Please look at the poll questions in front of you on the screens. The question is, the new impairment model is based on incurred credit losses or expected credit losses? And give 30 more seconds. Five seconds. Alright, time is up. And now we will share the results. Yes, Abu Bakr Sahab, 72% feel it's expected credit losses, 28% feels incurred credit losses.
72% are correct. Under new impairment methodology, expected credit loss approach will be applied. 72% are correct. Now we shall be having another pop-up question before we move to the cash flow hedge. So please.
The question is in front of you now. I'll read the question out. The new impairment methodology, need for a trigger event, no need for a trigger event.
What is the question?
The new impairment methodology, need for a trigger event, no need for a trigger event.
It was reading outside. I heard half an hour before.
30 more seconds. I must have doubts about this. Five. Alright, time is up. We'll share the results. 43% voted for need for a trigger event. 57 voted for no need for a trigger event.
57 are correct. There is no need for trigger event under new impairment methodology. there is no need for triggering it under new impairment methodology. Okay, let's move further. Cash flow hedge. A hedge of the exposure to variability in cash flows that is attributable to a particular risk associated with all or a component of a recognized asset or liability, such as all or some future interest payments on variable rate debt or a highly probable forecast transaction, and could affect profit or loss. See here, like we saw that in case of fair value hedge, in fact, when you want to hedge a fixed item, this means you are talking about fair value hedge. But here, if you are going to hedge a variable item, this means you are going to use cash flow hedge. For example, if we look at a couple of examples, the first example is proceeds from future sales in a foreign currency. Proceeds from future sales in a foreign currency may receive a lower amount in local currency. Like you are in Pakistan and you sold textiles to a USA client. So your USA client will be paying you after 2 months, $200,000. You are afraid that you may receive a lower amount. Why? Because of the changes in the exchange rate over a period of 2 months. So this means you want to hedge the variability of receipt in terms of rupees. Your receipt in rupees can be variable due to changes in the exchange rates. So you want to hedge this variability. So this is cash flow hedge. Second is forecasted purchase of fixed asset in a foreign currency. You have agreed with the supplier that you will be buying that asset at 20,000 say dollars, but due to changes in the exchange rate, the amount which you will be paying ultimately in rupee term may vary. So you want this variable amount to be hedged. So this means you want to hedge the variable item. So this will be classified as cash flow hedge. Similarly, future interest rates will rise on its debt finance. Means if you have you issued some bonds with coupon LIBOR rate of say LIBOR plus 0.5%. It means that in the future you will pay interest in line with the market because LIBOR reflects the market conditions. But you don't want to pay in line with market. You want to know how much you will pay in the future as you need to make some budget. So this is the variable amount. You want to hedge this variable amount with fixed. So you are hedging a variable item because you want to be sure how much you want to pay. You want to pay fixed. So therefore you enter into an interest rate swap. Interest rate swap to receive LIBOR 12 months, to receive variable and pay fixed. This is a cash flow hedge. You fix your cash flows and you will always pay say 2%. If under swap agreement you agreed that you will pay 2%, you always pay 2%, the other party will pay LIBOR. You will receive LIBOR plus whatever percentage you agreed with the other party, this much you will receive, and you will pay to the other party 2%. So these are the examples of the cash flow hedge. Okay, let's explore its accounting treatment with the help of this illustration. Illustration is Dynamic Steel Limited signed an agreement on 1st June 2013 for import of equipment for 50 million SK. So this is some sort of foreign currency. According to the agreement, the plant was delivered on 1st November 2013 and invoice therefore was paid on 1st December 2013. In order to hedge the commitment to pay 50 million SK, on 1st June, DSL entered into a forward contract to buy the required SK on 1st December 2013 at a fixed exchange rate of SK1 is equal to rupees 50. Exchange rate on various dates are as follows. On 1st June 2013, spot rate 14.5, forward rate 15. On 30th September 2013, spot rate 12, forward rate 12.39. On 1st November 2013, spot rate is 11.15 and forward rate 11.35. Then on 1st December, on the date of the payment, spot rate was 10 and so the forward contract was closed. It is DSL policy to adjust any gain or loss arising on forward contract to the carrying amount of the imported goods. DSL accounting year end is 30th September required. Prepare accounting entries relating to the above transaction on each of the above dates in accordance with the requirements of IFRS. So what is the accounting treatment? Accounting treatment for cash flow hedges. Number one, the portion of the gain or loss on the hedging instrument that is determined to be effective hedge is recognized in other comprehensive income and creates a reserve in equity. The ineffective portion will be recognized in profit and loss. Second, okay, so this is the accounting treatment. This is the accounting treatment, first part of the accounting treatment, whereby any gain or loss on the hedging instrument will be recognized so far as it is effective in the other comprehensive income and creates a reserve in equity. The ineffective portion will be recognized in profit and loss. See, for example, let's say change in fair value of a hedging item. Let's suppose change before discussing the solution of the last illustration. Let's have a very small illustration. Let's suppose that change in fair value, change in fair value of hedging instrument is 100 plus, okay, mean gain. and change in fair value of hedged item is minus 90. It means that this hedge is not perfectly effective. Perfectly effective means both gain and loss are the same. It's not perfectly effective. In such case, change in fair value of hedging instrument would be 90. Like as I said, like if had it been 90 instead of 100, so we can say that this is a perfect hedge. But here this change is 100, whereas change in the fair value of the hedged item is 90. So this is not a perfect hedge. However, percentage of offsetting is 111%, like 100 divided by 90. So this will give you 111%, which is very effective. You can say that this is very effective. Now the effective part of the change in fair value of the hedging instrument is then 90. So this 100 has two parts. 90, which you can say that this is an effective part, and 10 ineffective part. So effective part will be recognized in OCI. This will go to OCI. This will go to profit and loss. Okay, my pen is this profit and loss. This will go to the profit and loss. I hope it should be clear. The portion of the gain or loss on the hedging instrument, this is the hedging instrument, this is the gain on this hedging instrument, 100 is the gain, is determined to be effective. Of course, out of this 100, 90 is determined to be effective. That will be recognized in the OCI, other comprehensive income, whereas the ineffective portion, which is 10, will be recognized in profit and loss. Okay, so this is the first step. Next is when the hedging transaction results in the recognition of an asset or a liability, changes in the value of the hedging instrument recognized in equity, the reserve in equity. So there are two options. You can go for either of these two options. First is you can adjust that equity reserve against the carrying value of the asset or liability, or affect the profit or loss at the same time at the hedged item, for example, through depreciation or sale. In our last illustration, we can see that here it is mentioned that it is DSL policy to adjust any gain or loss arising on forward contract to the carrying amount of the imported goods. This means they want to apply, this company will be applying this this policy. Okay. Let's have an empty document so that I could explain you the accounting treatment for. So again I can divide into two portions. Though first portion is not required, but anyway at the end we need it. Hedging instrument. Hedging instrument. In this case, please excuse me, hedging instrument in this case is I was feeling hot. Hedging instrument is hedging instrument in this case is forward contract. Forward contract. Hedged item is import of equipment. Import of equipment for SK, this is a foreign currency, SK 50 million. So this means this will not affect at this point in time. When we entered into the forward agreement, this agreement will not affect our accounts. Why? Because this is an agreement. When we will actually buy this asset, then this asset will be recognized in our accounts. So far as entering into the agreement on 1st June 2013 is concerned, this transaction will not affect our accounts. However, this is our hedged item because we have a risk that we may have to pay more in our local currency. So variable item. So as a result of change in the exchange rate, so we may have to pay more. So we are hedging variable items. So this means cash flow hedge. Hedging instrument, forward contract. Because we have entered into this agreement, so this will be recognized in our financial statement. Because standard says you will be recognizing a financial instrument when you enter into an agreement for that instrument. So when we enter, of course, we enter into the agreement on 1st June 2013. 1st June 2013 at the rate 15 rupees 15 against, so this means we shall be selling SK 50 million. So this will give us 50 million into 15. So we have entered into a binding agreement that we will be paying this much rupees in order to get 50 million, SK 50 million. Okay. So this was the situation on 1st June 2013. Now what will happen? Let me change the color so it may benefit you. 30th September 2013. On 1st June 2013, the rate was 14.5, whereas this was the rate of future on that date. What happened on this date? Spot market moves to, spot rate moves to 12. So this means there is a gain, nominal gain. Of course, this is not actual gain. There is a nominal gain calculated by 14.5 minus 12 is equal to 2.5 14.5 minus 12 is equal to 2.5 per SK. So this is the gain. Total gain will be equal to 2.5 into 15. So total gain is 125. Total gain is equal to okay 125. So what happened here? Here on 30th September 2013, the rate is moved to 12.39, whereas we have agreed to buy each SK for rupees 15. So this means now forward at this date, forward can be agreed at this rate. Forward contracts are being quoted at this rate. So this means we agreed a higher amount. So this means there is a loss. Loss is equal to 15 minus 12.39. This will give us 2.61. per SK. This will be the loss. So total loss is equal to 2.61 into 50 million. This will become 130.5. Okay. So what will be the entry for this loss? First of all, we shall determine its effective portion. Effective portion is equal to the gain in this market, 125, and ineffective portion is the difference between these two, which is 5.5. So the entry will be debit profit and loss account with 5.5 debit. I am using the term OCI for other comprehensive income. OCI account with 125, the effective portion, and credit financial liability, means forward contract. Again, I will repeat, we learned at the very start of financial instrument that when forward contract are at loss, so this will become your financial liability. Forward contract account with 130 point, sorry, let me rewrite it, 130.5. So this will be the entry you will pass on 30th September 2013. Next, so let me draw a line here because the color is same, so that Okay, now on 1st November, 1st 11, 2013, spot rate has moved to 11.15. So earlier you can buy each SK1 with 12 rupees, but now on 1st November you will be able to buy one SK with 11.15. So again there is a gain. Gain is equal to 12 minus 11.15, because the gain related to the difference between these two spot rates has already been recognized on 30th September 2013. Now the rate is moved further, so we shall be calculating the difference, not recognizing. These are only nominal gains, and this will give us the idea that whether the hedged item is in gain or loss. So this hedged item is in gain, so we can calculate the total gain. Total gain can be calculated by multiplying gain on each one SK with 50 million. So this will give us the total gain as a result of this move. Okay, now we shall see the situation in future market. What happened in the future market? Of course, we should expect a loss. In future market, the rate has moved to 11.35. The rate has moved to 11.35 from 12.39. It has moved from 12.39 to 11.35. So we can calculate loss, which is the difference between these two amounts, 12.39 minus 11.35. This will give us a loss of 12.39 minus 11.35. This will give us a loss of 1.04, I suppose, 1.04, and the total loss will be, total loss in the forward market will be 1.04 multiplied by 50 million. This will give us 52 million loss. So the entry will be here there will be no entry, because hedged item is not recognized in your financial statement. This is only for the calculation purpose, just to see the effective and ineffective portion. See, again, this is highly effective because there is a gain of 42.5 and here is a loss of 52. It is highly effective, but it is not perfectly effective. When will it be perfectly effective? When the gain and loss are equal. So we will calculate, we will pass the entry for the effective portion, which is effective portion. Here the effective portion is equal to 42.5. Ineffective portion is equal to ineffective portion is equal to the difference between these two amounts. The difference between these two amounts is 52 minus 42.5. So 9.5. This is the ineffective portion. So this will go to the profit and loss account. Likewise, we will make an entry debit profit and loss account. This loss will go there, 9.5. And equity reserve within the through other comprehensive income, 42.5, and the same account will be credited as we did on the top, mean financial liability, which is in fact our forward contract, will be credited. This is in fact the forward contract. Will be credited with 52. So next, what happened? Because I'll have to move further, and the effect of moving further on this sheet means my earlier data will be raised. So if you have any question related to that, related to the calculations in front of you, please ask now. And at the same time, please note this entry. Please note this entry which we made on this. So these entry you must note on a piece of paper, so that when we move forward, because I'll be referring these entries again in order to make you understand the entries when you actually receive this equipment, and subsequently when you make the payments. So if you have any question, so here we have a couple of questions. Mr. Okay, let me check out here about the questions. So we have answered, let me show you till which question we have answered. Okay, I have answered till, okay, come down please. Okay, you keep on narrating the question. I'll very quickly tell you whether I have answered it earlier or not.
Okay, it's a question from Syed Qadir Hassan Gilani. He's saying, I believe that the credit and risk department has a job as well in identifying.
Answer next.
Okay. Rashid Hanif is saying, please first define what is hedging.
Next. Done.
Dishan is saying, nice drawing.
Next.
Okay. Hussein Abdullah is saying, with regards to hedged inventory gain, it should not be 20,000.
Answer
okay.
Next. Even Hussein's next question is answered. Move to the next.
Have you answered Fateh's question? In futures contract transaction, there is no physical change in the goods.
Yes, answered next. I suppose from here onward we need to answer the question. I suppose.
Okay. Okay.
After approximately 8-10 minutes, we shall be having Maghrib prayer break.
Rashid Hanif is asking, please upload the recording of the financial instrument second one. That has already been done. Munir Malik is saying, please let us know accounting entries of cash flow hedging. accounting entries of fair value hedge, and then there's a third question.
Munir, I made all the entries. If you listen again the recording, you will find there. So far as the cash flow hedge accounting is concerned, these are the entries. Though it is not yet finished, we continue cash flow hedge, but these are the general entries related to the cash flow hedge.
Okay. Munir's this next question is, he's saying in oil industry, if a company hedged oil sales at 60 billion for 2017 and the current oil price is around 50 billion, how I post my entries of hedging?
So who is this gentleman?
Munir.
Munir Malik, see, this is your specific question because it depends if you have oil inventory with you and you are worried about its price. So this will be the fair value hedge, and so what you will be doing, your petroleum inventory is basically your hedged item, and if you enter into the petroleum futures, that will be your hedging instrument. So any change in the value of hedged item or the hedging instrument will be recognized in the profit and loss account.
Imran Samad is asking, can you explain effective and ineffective portion one more time?
Who is this gentleman?
Imran Samad.
Imran Samad, see here, if you see here, this is our nominal working. So this was the gain on our hedged item, nominal gain. This is not an actual gain, just we estimated, okay, this was like spot rate at the date we entered into the transaction. On 30th September, this has moved to like 12. So there is a gain in the spot market. But when we look at the forward market on the same date, the rate has moved to 12.39. So here the loss is 130.5. So if you see the loss and this is the gain, both are not equal. If they are equal, this will be termed as a perfect hedge. But these are highly effective. This hedging is highly effective. So effective portion is equal to the 125. This is the effective portion. And the difference between these two is the ineffective portion. I hope, Mr. Samad, it should be clear. The difference, similarly, see here, this is the gain in the hedged item. See how much loss is there? 52 on the hedging instrument. So out of 52, 42.5, which is the gain, that is effective portion because that is exactly offsetting the gain we made on the hedged item, and the remaining amount is ineffective portion. I hope it should be clear. Next.
Adilul Haq is asking, while calculating gain and losses, we should compare the price in spot market with forward agreed price. But we are adopting a different approach here.
Who is this gentleman?
Adilul Haq.
Adilul Haq, see, when you want to calculate gain or loss on hedged item, so because this hedged item will be transacted in the spot market, so any rate will be compared with the spot market. When you will be calculating gain or loss on the hedging instrument, so that will be compared like with the change in the rate of that hedging instrument. See, you will be comparing forward rate against forward rate. So this is the approach given by this time. But anyway, this is not accounting. This is the financial management concept. If you just recall your P4 study, so whenever you want to calculate how much gain you have made, that is, you will be comparing the rate at which you agreed the forward contract and against the rate where the forward contract has moved from the rate you agreed at the date of agreement.
Sayyid Qadir Gilani is asking, when will the webinar end? Sayyid Qadir Gilani, it will end exactly in 1 hour 5 minutes. And Imran Samad is saying thank you very much.
Okay. Imran, welcome. Okay, before going for Maghrib prayer, I think we should have a break for Maghrib prayer. Then I will continue with the same question. This is 7.5 plus 557.5. So this will give us 725. So this will give us 725. So this way you have incorporated this equity reserve. So this will go to the property, plant and equipment. 167.5 on 1st November 2030. So now this liability will continue, of course. This liability will be of 50 SK million, which will be settled after 1 month, but subsequently this will be treated under International Accounting Standard 21 as a single foreign currency transaction. So any gain or loss will go to the profit and loss account. And likewise, any gain or loss of the financial liability will also go to the profit and loss account. So this was the total treatment. If I just quickly revise what I discussed, because there was some interruption in our recording. See, we have discussed these two entries. Subsequently, what happened on the same date, on 1st November 2013, we received the asset. When we received the asset, we learned in our slide that whatever balance is lying in the equity reserve can be adjusted in the carrying amount of that asset. So here in this case, if you just read through the illustration, it says the company has the policy. The company has the policy to adjust any gain or loss arising on forward contracts to the carrying value of the imported goods. So this is this will be adjusted. So this is the amount which will be paid using the spot rate. But in fact, why we have recognized 725? Because this 725 incorporate the effect of this equity reserve as a result of this hedging. Okay, so from where 125 comes on 30th September, you remember financial liability, we debited the OCI, mean in the equity reserve, and on 1st here, it can be seen here, on 1st November 42.5 was debited to the OCI, mean equity reserve, against the financial liability, which is the forward contract. So on this date, we bought this asset, we actually received this asset. So total reserve related to this hedged item was 167.5. So we need to make it 0. So we will be transferring, one policy could be to transfer it to the carrying amount of the asset. So here we have transferred to the carrying amount of the asset. So let's come back to our slides. Okay, we were here. See, when hedging transaction results in the recognition of an asset. So when we receive the equipment, changes in the value of the hedging instrument recognized in the equity. How much we recognize in the equity? 167.5 are adjusted against the carrying value of the equipment received. But you can apply the other option as well, affect the profit and loss account at the same time as the hedged item through depreciation or sale. For example, if this equipment was to be depreciated, at a rate of 10%, then this equity reserve could have transferred to the profit and loss account at the rate of 10%. This is another option. Now it depends on the company policy, which company, which policy they want to adopt. Okay. Then is hedge of net investment in a foreign operation. See, in this situation, an overseas equity investment that is subsidiary, associate or joint venture is hedged by a derivative or a non-derivative contract. So what is the accounting for this hedge? Hedge of net investment in a foreign operation. So what is the accounting for this? This type of hedge shall be accounted for. Which type? Hedge of a net investment in a foreign operation accounting treatment. This type of hedge shall be accounted for similarly to the cash flow hedges. This means any gain or loss on the hedging instrument to the extent of effectiveness will be recognized in the other comprehensive income under a separate reserve in equity, and the ineffective portion of the gain or loss will be recognized in profit and loss. The effective portion of the foreign currency gain or loss on the hedging instrument shall be recognized in other comprehensive income matched with the foreign exchange gains or losses on consolidation. The ineffective portion shall be recognized in the profit or loss. When the hedged item is disposed of, the cumulative gain or losses in other comprehensive income shall be recognized as part of the profit or loss on disposal. So this is very simple accounting treatment when you hedge a foreign operation. So this is, if you have learned the treatment of the cash flow hedge, so you will apply the same accounting treatment for hedging of net investment in a foreign operation. Okay, what are the major changes? Because hedging is not new for us. This is coming from IAS 39. But today we learned the new approach. But what are the major changes as compared to the previous approach? The first is fair value hedge. Fair value hedge, same as IAS 39. In addition, IFRS 9 ensures that hedges of investment of equity instrument held at fair value through OCI can be accounted for as a hedges. Previously, it was not allowed under IAS 39. Cash flow hedge, this is the same as old 39. Okay. So next is, other changes are not permitted hedging of net position, not permitted under IAS 39. No, it is permitted under IFRS 9. Further, an entity can no longer discontinue a hedging relationship voluntarily. This is permitted under IAS 39. An entity shall discontinue hedge accounting prospectively only when the hedging relationship fails to meet the qualifying criteria. The risk management objectives have changed, or the hedging instrument has expired, is sold, or terminated. See, there are some new requirements under IFRS 9. For example, the necessity of an effective economic relationship. See, here, organization cannot, on its own, discontinue hedging relation, which was the case under IAS 39. This objective criteria has to be met. Only then an entity can discontinue the hedge accounting. Okay. Next is the 80 to 125% criteria. Range prescribed in IAS 39 has been replaced by a more objective test based on internal risk strategies. See, an entity would anticipate that the gains or losses will offset before it enters into a hedging relationship. We know that when we want to enter into the future of the similar commodity, we know that whatever is the gain in the spot market, that will be automatically offset by the gains or loss in the futures market, because fundamentally we know that both markets move in the same direction. So gain in one will be compensated by the loss in the other. So it may not be perfectly effective, but it could be highly effective. So 80 to 125% criteria to measure the effectiveness is no longer there. So that's why while discussing cash flow hedges, I have not mentioned this criteria. Instead, the hedging relationship is anticipated to be effective throughout the life of the hedge by meeting all of the following requirements. For example, there is an economic relationship between the hedged item and hedging instrument. There should be an economic relationship. What is the example of economic relationship? For example, if I want to hedge the purchase of wheat in the future, so what I will do, I will enter into wheat futures. So there is an economic relationship between these two: the hedged item, which is the likely purchase of the wheat in the future, and the hedging instrument, which is the wheat futures. So both have an economic relationship. So this relationship should be there, number one. Number two, credit risk does not dominate the value changes. And the number third, hedge ratio is effective. And we learned what is the meaning of effective, that it should exactly offset the gain or loss on the other part. Okay. So other changes, these were the changes. So here we ends our discussion on financial instruments. So if we have any question, please, respected members, if you have any questions, please feel free to ask it now. You can ask the question. Okay. Please speak the last question. Last one.
Samula is saying, please repeat fair value hedging changes from 39 to 9.
Fair value hedging from 39. So these are the fair value, these are the changes. Samula, I would request you to watch the recording there. You can repeat this. Hopefully in a couple of days this will be uploaded on Vimeo. Hopefully maybe today or tomorrow morning. Tomorrow morning this will be uploaded, and then you will be able to repeat that material. So okay, fine. There was a question from one of our respected member related to talk about marked to market term. Mark to market term. So what is this mark to market term? See, this is basically American term, and you might have heard it in relation to the Enron scandal. In fact, what is this mark to market? This is basically okay. This is basically when you mark to market trading is when a stock or security is held for an extended period of time and treated as if it was sold at the end of the period. Losses or gains are reported based on the stock security price at that time. Very simple. Mark to market is basically what you do. You okay, if you have a stock or security which is included in your financial statement at 100, say 1000. So at the reporting date, you remeasure it. You determine at what price you can sell it, at what price you can sell it at reporting date. Say you can sell it at reporting date in the open market at 1150. So you will be increasing this asset from 1000 to 1150, and the difference will go to the profit and loss account. This was one of the way through which Enron was increasing its profits in order to meet investor expectations. You all know about the Enron scandal. So how were they meeting the investor expectation of the profitability? This was one way of meeting the investor expectation, because they have a lot of long-term energy contracts on their balance sheet. So at the end of the year, they used to apply this mark-to-market policy. Means they used to determine at what price those long-term energy contracts can be sold, so that they were increasing or decreasing the value of those long-term energy contracts to the market value. The difference they were sending to the profit and loss account. And what they were doing all the time, they were increasing the value of these long-term energy contracts. Why? Because there was in fact no market. Because Enron was so dominating. It was number one, it was number two. There is no effective competition in the market. So this means the determination of the market prices at the reporting date was largely a subjective matter. So keeping in view the amount they need for increase in the profitability, they used to increase the value of their long-term energy contracts in the name of mark-to-market policy for meeting the investor expectations. So I hope the respected member who asked for the explanation of mark-to-market policy, that member is clear. Then I promised I think in the last session that I will be trying to find some published financial statements where you can see the presentation of these various financial instruments, like compound instruments, whereby you have bifurcated it between equity portion and debt portion, and likewise other financial instruments. So because of the copyright matter, I will give you the link. The link is, you can go to the Deloitte, which is Big Four website. From there you can download model financial statement under IFRS. So we cannot send those financial statements from ACCA platform because of the copyright matter. Simply that is free for everyone. You can go to the website of Deloitte, and from there you can download model financial statements. Okay, before moving to the next, if we have any question, we can answer that. Okay. Okay. Now our last topic is fair value measurement. Fair value measurement. Fair value measurement. See, some IFRS require or permit entities to measure or disclose the fair value of assets, liabilities, or their own equity instruments. For example, International Accounting Standard 16, International Accounting Standard 14, or IFRS 9, etc. Because those IFRS were developed over many years, the requirement for measuring fair value and for disclosing information about fair value measurements were dispersed, and in many cases did not articulate a clear measurement or disclosure objective. As a result, some of those IFRS contain limited guidance about how to measure fair value, whereas others contained extensive guidance, and that guidance was not always consistent across those IFRS that refer to fair value. inconsistencies in the requirements for measuring fair value and for disclosing information about fair value measurements have contributed to diversity in practice and have reduced the comparability of information reported in financial statements. IFRS 13 remedies that situation. See, one point is very important. Remember, this standard is only tell you how to measure. That's it. That's it. How to measure fair value. This answers only this question. The whole standard answers only this question. Okay. This standard sets out the definition of the fair value. There is a change in the definition of the fair value, but substantially it is more or less same. But there is more clarity in the definition. Set out in a single IFRS, a framework for measuring fair value. This means all guidance in other standards about fair value measurement, like ISA 39 or IFRS 9 or ISA 16, has been superseded by IFRS 13, and you don't just care about it. The objective of IFRS 13 is to define what is the fair value. So, okay. Then is the third one is disclosure about fair value measurements. See, whenever a fair value become an issue in a separate standard, so the answer will be how to measure a fair value. IFRS 13 will provide an answer for a question that is how to measure a fair value. But we need to remember certain things about the scope. This standard does not apply to share-based payment transaction within the scope of IFRS 2. We have had a lecture on IFRS 2 as well, right at the start of the sessions. That standard itself provides the detailed guideline for the measurement of the fair value wherever required. So you will not consider IFRS 13 guideline while treating share-based payments. So for them, IFRS 2 will be the relevant standard. Similarly, leasing transactions within the scope of ISA 16 or leases or IFRS 16 leases. So those standards will provide the relevant guideline for the determination of fair value. Like in case of leases, if we just recall that we need to measure it at the lower of fair value and the present value of the minimum lease payment. So how that fair value will be calculated, that will be dealt with in accordance with the ISA 17 or IFRS 16. This IFRS 13 will not be applicable. And measurement that have some similarities to fair value but that are not fair value, such as net realizable value under net realizable value such as under ISA 2 inventories or value in use, ISA 36, impairment of assets. Impairment of assets. So, sorry for interruption. Okay. So this is the scope. Except these three, wherever any other standard mentions about fair value, IFRS 13 guidelines will be applicable. So let's have a look at some important terminologies. First of all, some assets like shares of the British Petroleum may be traded in more markets. See, for example, British Petroleum is being traded in New York Stock Exchange, and these shares are being traded on London Stock Exchange. So this is quite possible that some assets or liabilities can be traded in more markets. See, so the first terminology is principal market. So which one will be the principal market? So these are the important terminologies which will be utilized while discussing the remaining requirements of the IFRS 13. So principal market is the market with the greatest volume and level of activity for the asset or liability. Within these two markets, any market, New York Stock Exchange or London Stock Exchange, whichever has the greatest volume of level of activity for these shares, that will be termed as principal market. But this principal market is seen with reference to the entity. This is seen with reference to the entity. For example, if we take the example of the shares of the British Petroleum. For security broker can trade, say, in broker market, and they can trade in retail market. Most of the transactions take place in interbroker market. But for another company which is not a broker, like a textile mill, if they have invested in the shares of the British Petroleum, they do not have access to the interbroker market. So for them, retail market is the only available market which has the greatest volume of level of activity. So for security broker, interbroker market will be the principal market. Whereas for textile mill, because it does not have access to the interbroker market, though interbroker market has greatest volume of level of activity, but because textile mill cannot access this market, so while determining the principal market, this will not be considered. For textile mill who has that has invested in the British Petroleum shares, retail market will be the principal market. So this being very simple, if there are more than one markets for an asset or liability, so wherever the market is being traded with greatest volume and the level of activity, that will be the principal market. So this is with reference to the entity. So entity will see which one is the principal market for that entity. Okay. Next terminology is most advantageous market. Most advantageous market. See, the market that maximizes the amount that would be received to sell the asset, or minimizes the amount that would be paid to transfer the liability after taking into account transaction costs and transport cost. So we shall be using this terminology as well. So this is most advantageous market. Then is the unit of account, definition of unit of account, which is the level at which an asset or a liability is aggregated or disaggregated in an IFRS for recognition purpose. Okay, for example, in IFRS 9, the unit of account is generally an individual financial instrument. In IFRS 9, the unit of account is generally an individual financial instrument. ISO 36 states that an entity should measure the fair value less cost of disposal for a cash generating unit when assessing its recoverable amount. Under ISO 36, sometimes the unit of account is cash generating unit, whereas under IFRS 9, generally an individual financial instrument is the unit of account. Okay, next definition is the highest and the best use, the use of a financial asset by market participants that would maximize the value of the asset or the group of assets and liabilities, for example, a business, within which the asset would be used. Okay, we can understand highest and the best value with the help of an example. Example number 2 is available with you. So this is specifically for the non-financial asset. This is not for the financial asset. So if we go to the example number 2, so we can find example number 2 from here. It should be example number 2. Okay. Example number 2. So this is example number 2. An entity acquires land in a business combination. The land is currently developed for industrial use as a site for a factory. The current use of land is presumed to be its highest and best use unless market or other factors suggest a different use. Nearby sites have recently been developed for residential use as sites for high-rise apartment buildings. On the basis of that development and recent zoning and other changes to facilitate that development, the entity determines that the land currently used as a site for a factory could be developed as a site for residential use, that is, for high-rise apartment buildings. Because market participants would take into account the potential to develop the site for residential use when pricing the land. See, the highest and the best use of the land would be determined by comparing both of the following. See, first they will see what is the value of this land as currently developed for industrial use. The land would be used in combination with other assets such as factory or with other assets and liabilities. So, what is the value under this option, and what is the value? The value of the land as a vacant site for residential use, taking into account the cost of demolishing the factory and other costs, including the uncertainty about whether the entity would be able to convert the asset to the alternative use, necessity to convert the land to a vacant site, that is, the land is to be used by market participant on a standalone basis. So the best use, the entity highest and the best use will become the value for this land. So this is the value measurement for the non-financial assets only. Non-financial asset only. In case of going for the worst case scenario, you will go for the highest and the best use value of the non-financial asset. So you have a land, you just evaluated what are the possible usage of this property, and which option will offer you the highest and the best use. So you will be pricing that non-financial asset by using the highest and the best use value. Okay, now let's come back to our slides. Okay, this was the terminology. Next is market participant. See, buyers and sellers in the principal or most advantageous market. We discussed in earlier slides what is the principal market with the highest volume of activity, with the highest volume of activity, volume and level of activity, with the highest volume and level of activity. And then we learned about most advantageous market. See, buyers and sellers in both these markets for the asset or liability that have all these characteristics. Number one, they are independent of each other. That is, they are not related parties as defined in International Accounting Standard 24. Market participant, this is the first condition. Second, they are knowledgeable, having a reasonable understanding about the asset or liability and the transaction, using all available information, including information that might be obtained through due diligence efforts that are usual and customary. And then they are able to enter into a transaction for the asset or liability, and they are willing to enter into a transaction for the asset or liability, that is, they are motivated but not forced or otherwise compelled to do so. Any buyer or seller who has all these characteristics in principal market or most advantageous market will be termed as market participant. Meaning he should be independent, knowledgeable about the market, ability to enter into the transaction, and willingness to enter into the transaction. Mean it's not a forced sale or compelled to do so. He is not compelled to do so. So this is the market participant. Okay. Further is the terminology exit price. The price that would be received to sell an asset or paid to transfer a liability This is termed as the exit price. The price that would be received to sell or paid to transfer a liability. This is exit price. And then another terminology is entry price. The price paid to acquire an asset or received to assume liability in an exchange transaction. And then last terminology is orderly transaction. What does it mean? Orderly transactions happens when two key components are present. See, number one, there is adequate market exposure in order to provide the market participant the ability to obtain knowledge and awareness of the asset and liability necessary for market-based exchange. In other words, the asset or liability traded frequently with actual market quotations. And second component is the market participants that are motivated to transact for the asset or liability and not forced to do so. So this is the definition of the orderly transaction. Okay, now let's come to the main definition, which is fair value. What is fair value? See, the price that would be received to sell an asset or to pay a transfer liability. The price that would be received to sell an asset mean or paid to transfer an liability mean this is exit price, in fact. Sorry. In an orderly transaction, we know what does it mean, orderly transaction, which is not a forced sale, and knowledgeable willing parties. Between the knowledgeable and willing parties, any transactions that happens between the knowledgeable and willing party, that is orderly transaction. Between market participants who are independent, knowledgeable, willing, and willing to enter into the transaction, this is not a forced sale. They are not compelled to do so. So this is the definition of the fair value. So this focus on the exit price, in fact. Okay. So the important thing is that fair value measurement is market based, not the entity based. This is market based, not the entity based. So in fair value, we shall determine 4 things. First, particular asset or liability being measured. What we want to measure, asset or liability? Financial asset, financial liability, or non-financial asset, non-financial liabilities. Okay, first we must be clear about that. Second is, for non-financial assets, the highest and the best use of the asset, and whether the asset is used in combination with other assets or on a standalone basis. Then market based. What is the value in accordance with the market based? Whether the market is principal market or it is most advantageous market. And then the last one, use the appropriate valuation techniques when measuring the fair value. See here, of course, This is the first step. You need to identify what you want to do. Of course, I would say that these are not two steps. So this is one step. For example, you need to decide financial asset, financial liability, non-financial asset or non-financial liability. What you want, whose fair value need to be determined. So you need to decide in these two steps. So further in these two steps, if you want to measure the fair value of a non-financial asset, then the highest and the best use of the asset will be considered instead of the worst case scenario. And then as for financial assets and financial liabilities, your fair value should be based on the market. Preferably it should be principal market, or if it is not available, if it is not there, then most advantageous market and the appropriate valuation techniques. And okay, what are the valuation techniques used to maximize the, okay, fine. Then non-financial asset, highest and best use. Here, in relation to the non-financial assets, IFRS 13 requires to measure the fair value based on the asset highest and best use from a market participant perspective. That takes into account the use of asset that is physically possible, and it takes into account the physical characteristics of the market participant would consider, for example, property location and size. Then legally permissible, it seems to account for legal restrictions on use of the asset that market participant will consider. Like here we have seen in our last example, zoning regulations, or financially feasible, which takes into account whether use of the asset generates adequate income cash flow to produce an investment return that market participant would require, and it should incorporate the cost of conversion of that asset into account. So, principal or the most advantageous market. See, if it is not possible, or there is no principal market, then most advantageous market. In most advantageous market, what we do, we take into account the transaction cost and transport cost and see which of the advantageous market will maximize our return. So we will take the fair value in that most advantageous market. But for the calculation of the fair value, we ignore the transaction cost. See, if principal market is there, we will go for the principal market, where the highest level and volume of activity is there. But if there is no principal market, there are various markets in which this asset or liability can be traded. So there we will go for that market which will maximize our return after taking into account the transportation cost and the transaction cost. But this first step will be for the determination of the most advantageous market. But once most advantageous market is found, we will ignore the transaction cost. Then is valuation techniques. See, this is not accounting. This is basically financial management techniques, like how you will determine the fair value. One approach is market approach. And uses prices and other relevant information generated by market transactions involving comparable and similar assets, liabilities, or a group of assets and liability, for example, a business. Here, in this approach, you will be using the market-based prices. And similarly, cost approach reflects the amount that would be required currently to replace the service capacity of an asset, current replacement cost. See, for example, current replacement cost of asset under ISA 16. And then income approach converts future. But in case of income approach, this is normally entity based. So these are different techniques, and the inputs into these techniques will be preferably should be observable inputs, which are preferably market based, or if they are not available, then unobservable inputs can be used. Standard has defined 3 levels of inputs. One is level 1, inputs quoted prices in active markets. This is the most desirable level. These should be used in those valuation techniques. But if these are not available, then one can go for the level 2 inputs. These are the inputs other than quoted market price included within level 1 that are observable for the asset or liability either directly or indirectly. For example, interest rates. Interest rates, for example, when you determine the fair value of financial instrument at initial recognition, we all know that financial instrument at initial recognition should be measured at fair value. You can determine an interest rate or yield curve, and these things are available at commonly quoted market, that is level 2 fair value input. So remember, when you determine the fair value of that debenture or shares, that redeemable, anything like that at initial recognition, you are going to use that interest rate, the market related interest rate. It's not for 100% identical transaction necessarily, but it still comes from a market and they go into level 2. So if these 2 inputs are not available, then you can go for the level 3 inputs that are unobservable inputs for the asset or liability using the entity on assumptions about market exit value. So this means in these valuation techniques, it is preferable you should use level 1 or level 2. But if they are not available, then you can go for the level 3. But when you use the level 3, the volume of disclosure will be high because that involves more subjectivity. Level 3 is more subjective, whereas level 1 and level 2 are they provide you the value which is objective. So the lower the level, this will increase the subjectivity in your inputs. So the higher the level, this will increase the objectivity of your inputs. So what standard has said that if you use, for example, level 1, because this is your objective level, so a lower level of disclosure will be required. But when you use level 3 inputs, this will necessitate a huge amount of disclosure so that you would share with the user of the financial statement that what assumptions you have used, whether they agree with you or not, or they can make their own assumptions. So these are the inputs which can be used. Further, in case of liabilities, just you need to see is there any quoted prices. Okay, use those quoted prices. Similarly, then you come to the level 3, and when you come at level 2, is there identical item based on asset by another party? Yes, then use the fair value of the identical assets. Then is if there is a non-performance risk, because when you issue a financial liability, you yourself can default on your interest and principal payments. So you can default on that. So that's why there could be a non-performance risk. So that non-performance risk should be taken into account. Further, you can determine fair value on a net basis, provided all these three criteria are met. There is a documented risk management investment strategy, information to key management personnel, and fair value at the end of each period. These are the disclosures. So if you people have any question, though I have tried to explain it, this standard IFRS 13, but still if you have any question, please feel free to ask. Due to shortage of time, I could not include a couple of illustrations which I wanted to, but anyway, when you will rehear the recording, so you will be easily able to appreciate the main concept underlying this IFRS 13, because this just tell you how to determine. mean it should be market based. Like, for example, share option. This could be your financial asset or financial liability. How to determine its fair value? Either you will be using binomial model or you will be using the Black-Scholes model. See, in both models, from where the inputs are sourced. So those inputs are sourced from the market. So this standard stress on the on those inputs which are market based. So this way, this tells you how to measure the fair value. Okay, thank you very much from my side. If you want to run, if you have any question, please.
Imran Samad is asking, could you please explain level 1, 2, and 3 approach for the purpose of disclosure?
Imran, for level 1, you will have to go for the minimum disclosures. Why? Because in case of level 1, you are using objective data, market-based data, which is like if you go back to that slide, which is available from the quoted markets. Whereas when you go for the level 2, this is also objective data, but you will be going for like identical transactions. So the level of disclosure will increase. But if you use level 3 inputs in your valuation techniques, so you will have to give a lot of disclosures. Now remember one more point. If you have used level 1 as well as level 3 inputs for the calculation of a fair value, standard says you will have to disclose the information required for level 3. This means you will have to go for the lowest level so far as the disclosures are concerned. Like if you have used the inputs which are level 1, all the input which is level 1, then you can go for the disclosure related to the level 1 which are minimum. But if you have used a combination of level 1 and level 2 inputs, then you will have to disclose the information required for level 2. I hope, Imran, it should be clear. Next.
There are comments coming in, but in the meanwhile, my typical questions for today's session. So first of all, I would like you to give me feedback about this session. I am just about to put up a poll on this. So the poll is in front of you. Can all of you give us your feedback on how do you find the session? In the meanwhile, those who have any questions should put them up. Okay, take 10 more seconds. Very quickly, give us your feedback. It's very important. All right, that's all. Thank you very much. I'll just share the results with you. Yeah, today's feedback is that 39% feel this was excellent, 50% feel this was very useful, 11% feel this was good. 0 below average, 0 unacceptable. Thank you very much. This was very positive feedback. My last question to you: where are you currently residing? Pakistan, Middle East, Sri Lanka, Bangladesh, and others. Please mention your country of residence. Once again, in the meanwhile, those who have any questions to ask, please put them up. Otherwise, I think we're almost done with the contents. Thank you very much. I think that's all about it. I'll share the results with you on this as well. So 56% from Pakistan, 37% from Middle East, and 7% from other countries. Fantastic. Thank you very much. This was very valuable. Let's revert to the questions again. Let me see if there are any questions that we have to answer. There's one comment from Rashid Hanif saying that the recording on Financial Session 2 is not there. Rashid, I'll just double check. The recordings for this session, the previous session, they both be uploaded. I'll make sure of that. Thank you very much. If you have any questions that comes to your mind afterwards also, you have the contact details of the trainer. So you can always write to him. And I can see him smiling, but that's a commitment to the members. Thank you very much. It was fantastic having all of you with us. I'm sure you would have enjoyed the session. We've got excellent feedback, and I'm sure you would have enjoyed the session today as well.
And thank you very much from my side as well for giving such an excellent feedback. Thank you very much.
Great. One last announcement, and that is tomorrow's session.
Yes.
And tomorrow's session is about income taxes. Is it?
Yes.
Okay. The session begins at 1 o'clock Pakistan time, which would mean about 12 o'clock Middle East time. And it will last for 3 hours. It's a shorter session. It will last for 3 hours. And tomorrow my colleague Ahmed Bilal will replace me, and I have to travel for business. So it will be over to Mr. Abu Bakr and Ahmed Bilal tomorrow. Thank you all very much. Take care of yourselves, and those who are having a weekend, enjoy your weekend.
Allah Hafiz.